With chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week, the month, and the year to come. That's right, doing the 2025 outlook today. And we're glad you're with us today. It is Friday, December 27th, 2024. Hope you all had a wonderful and Merry Christmas. Big shout out to our producer, Jack, over at Neon Siren Studios with a birthday coming up tomorrow. Like I said, we're going to talk about the year ahead today, but before we jump into there, just a real quick recap of the week behind. Let me just say that Santa Claus is a jerk. At least he's being one this year, passing out coal like it's candy. Not a real pretty week for the market here. Everything was up a little bit, don't get me wrong, but it's just sloppy action. Doesn't look like a Santa Claus rally to me. Dow Jones up 0.3%, S&P up 0.6%, NASDAQ up 0.7%, Russell Small Cap Index was flat on the week. Volatility Index down a little bit, down 13%, but it bounced again today, up 8% today. It's at 15.95, so still in a place where it can certainly shoot up from here. Something I really don't like, we're going to talk more about in a minute, long-term bonds as measured by the TLT. Just getting clobbered, down 1.3% this week, down 7% this month, down 11% for the quarter. Not good, and it's making interest rates go higher, and that is a problem, which we're going to circle back around to here in a moment. When you take a look at the sectors, everything was lousy except for semiconductors. They were up 2.3%. Everything else was just flat to down or not up very much. Healthcare was up a little bit, up 0.6%. Everything else was just nothing really happening there. Technology up 0.6%, but everything else was like down 0.6%, 0.7%, whatever. Metals, gold down 0.2% on the week, and silver down 0.5%. So what's moving markets this week? Well, it's a time of year where there's not a lot of trading. A lot of people are taking off. So I can't really attribute this action to anything all that specific. I will say that I think that some folks are getting ahead of anticipated January selling. As we've talked about here on the podcast, we've got a lot of trimming we want to do. We're trying to push some of that off until the beginning of the year for a couple of reasons. One, because of the quote unquote Santa Claus rally. Normally, the market lifts pretty strong this last week of December into the first few days of January. So there's that. And then secondly, for tax purposes, for folks that have taxable accounts, trying to defer that taxation into the following year. So there's a lot of money managers in this industry that I think are looking to do some trimming when the calendar flips and start doing some selling here towards the end of next week. Maybe the market's getting ahead of that a little bit. Maybe folks who don't care about taxes are jumping there a little early. But I tell you what, I think that's maybe one thing that's scaring the market more than anything is interest rates. And I think maybe some of this is computer driven because rates on the long end continue to go higher. As a matter of fact, I'll put it to you this way. It has been the biggest move higher in long-term rates after a Fed rate cut than at any point in time in U.S. history. There's a major disconnect going on, and I will just say that it is concerning. It is concerning, and we'll talk more about it here in a minute. So let's go ahead and just move forward at the moment and talk about the 2025 outlook. So look, for those that you tune in and week out, this will be a little longer today. I like to sit down on my Saturday mornings and have a cup of coffee with you. You want to sip on a little bit slower this morning because we've got a lot to cover here when we talk about 2025. So look, it's been a good year for the market. Everybody knows that. Markets have been up, good returns across the board, really strong, really coming off of a strong 2023. The market has backed it up with another high double-digit return here for 2024. That said, there's been some things that have been bothersome. We haven't quite seen the breadth that we would like to see in this bull market. It's really continued to be driven by a handful of stocks. You know, this Magnificent Seven, as they call it, these top tech stocks that are in the S&P 500 really driving a lot of the gains. For example, you look at the S&P 500 and it's up 25% year to date, all stock, all S&P 500. But then you look at, say, for example, the equal weighted S&P 500 that has more exposure to energy, financials, just other parts of the market, only up 11.9% on the year. 25 versus 11.9. It is an historic disconnect between those two. The equal weight S&P, they're the same 500 stocks. They're just giving equal weight to all of them, whereas the traditional S&P index is market cap weighted and the larger stocks account for more of the exposure. What a huge difference, 25 to 12. You look at the S&P versus small caps. S&P up 25, Russell small caps up 10. Look at the S&P versus the Dow, 25 versus 14. We're just not seeing the breadth that we would like to see, the participation that we'd like to see across the entire space of the market. It just seems to be really too confined to a small cohort of stocks that have been driving things up. But it was still a good year, right? At the end of the day, it was a good year. Great year for BIG. Very happy with all of our models and all the returns across the board. Our most aggressive model right there with the S&P, our moderate models blowing away the Dow and everything else. So really happy with all of that. Great returns for the year. Everyone should be pretty tickled. Now we set our sights on 2025, and what does that look like? Let's go ahead and start with the economy. The economy has been hanging in. It's been hanging in pretty strongly, although there's a lot of areas of concerns. If you were to take some of the things I'm getting ready to talk about and put them on a chart and put recessions on the chart along with them, you would be scared when you looked at the following. When you saw the unemployment rate tick up as much as it's ticked up in the last 6 months, you would be scared because it looks just like it does before other recessions that we've had. When you look at the JOLTS information, those are job openings here in the economy. They have collapsed this year, just collapsed. And when you see that type of decline in job openings in the past, tends to reflect that right prior to a recession. When you look at credit card defaults, auto loan defaults, they look terrible. When you look at leading economic indicators, we've mentioned this on the show before, my goodness, this is the longest streak in U.S. history of lousy economic indicators, leading economic indicators, negative again. So that's not good. When you look at the yield curve has recently uninverted, right? It's been backwards where short-term rates have been higher than long-term rates. That has reversed itself. It's gotten back to a normal state. When the market has a long yield curve inversion like we've had, we actually had the longest one in U.S. history the last couple of years. When these things have reversed in the past, it's usually been prior to a recession. All those things on our radar have our attention. You look at the positives, consumer spending continues to be strong. Consumers continue to spend money. You look at the services part of the economy, been pretty strong there. The services number's been strong. Manufacturing showing some glimmer of hope here and there. They've been a little bit better. And just the overall GDP, the gross domestic product of the country, has been really strong. So even though there's all these concerns and things to keep our eyes on, the economy just continues to keep on chugging along in the face of higher interest rates, in the face of higher credit card balances, in the face of higher unemployment, et cetera, et cetera. So the economy continues to hang in, but there's a lot of areas to be mindful of. Now, I thought we were headed right towards a recession. Based off the data I just told you, I've been very concerned that we could be headed towards a potential recession in the beginning of 2025. Now, since the election, the markets have risen a lot, and I think that that might actually be another positive because what it does is it creates what we call a wealth effect. When markets go higher, people have more money in their accounts, they feel more comfortable, they're more confident in spending a little extra money, taking that extra trip, doing whatever. And we've had a really big move in the market since the presidential election. And that was on top of an already good move for the year. So this wealth effect could also play a role in pushing recession down the road and maybe delaying it for quite some time. So although I'm still minding my P's and Q's here and paying close attention to recessionary activity, don't see it yet. Now, another thing I'll say, the market has a history of starting to roll over 6 to 9 months ahead of a recession. And it's not done it yet, obviously. Now, many of you are business school economists, professors, like to correlate that with predictive ability of the market. oh, the market dropped 6 to 9 months ahead of a recession, predicting a recession. I've learned to disagree with that in my 25 years in this business. I've actually gotten to a point where I think it kind of goes hand in hand with the wealth effect I just talked about. I think sometimes a rollover of the market is more of a cause and helps to lead to a recession versus a predictive measure. So that's something to be mindful of too. The market's remaining pretty strong right now, but if it were to start to deteriorate pretty substantially, that wealth effect will disappear and people might start clamping down and be a little more cautious. Businesses too, think about this. Corporations, they're more apt to spend money and invest and do things when their stock prices are up, when capital is a little free and easy. When their stock prices are down and things are a little tight, not so much. So all that plays a role. So anyway, all those things are going on. Additional, when it comes to the economy that we're watching, is inflation. Look, it was really ugly there a couple of years ago. It was very, very ugly. And 9 to 10% at one point, and it's come far, far down from that. We're down just below 3% on the inflation front, but it still looks sticky. There are areas that just aren't really cooling off the way we like to see. And I wonder at times if the interest rate move that we've seen since the Fed has been cutting rates is indicative of an inflation concern. When you look throughout history, inflation cycles have two peaks. 87% of all the inflation cycles we've had have two peaks. So inflation spikes, the Fed acts, brings inflation down, things cool off, and then inflation tends to spike again. Now, it doesn't happen every time, but 87% are pretty strong odds. So maybe the market's worried about that. Maybe that's why bonds have been acting the way they are. I'm not sure, but we'll talk more about the bonds here in a moment. Let's stay on the course of the economy. The next impact that we have to look at are the political policies that are going to be in place moving forward. And look, make no mistake about it, I'm pretty excited about some of the things that the incoming administration wants to do. They're talking about government efficiency and taking a good look at government waste and all that. I think that's fantastic. I think some of the policies that will be beneficial to the economy, easier energy, less regulation, the tax cuts from 2017, they're going to stay in place. They're not going to go away. That was a big concern moving into this year, was that the tax cuts were going to go away. I think all those things are positives. But listen, Trump is coming into a very different economy than he did the first time. The first time he came into office, interest rates were really, really low. The market had been sloppy. I personally think we had a recession in 2015 into 2016. If you go back and look at the data, I think the government lied about the GDP. They had 2 quarters back to back where they said it was up 0.1% and 0.2% or something like that. I mean, barely call that positive. And they overreported job creation this past year by over 800,000 jobs. They said they created 800,000 jobs that they didn't create. So you have to kind of take government data with a grain of salt. And the markets were ugly. It was just an ugly period of time, 2015 and 16. So the economy is coming off of a slow patch, to say the least. Interest rates were still very, very low. Energy prices have been high, things like that. And as Trump came into office and these policies started to go into play, it just went along with the market coming off of a kind of a bad soft spot to begin with, and things worked out very nicely. He's coming in very different, coming into a hot economy, a market that is stupid expensive, which we're going to talk about in a moment, interest rates, which are elevated, way up there, energy prices, which are already low to begin with, and things look stretched. So it's going to be interesting to see how all of that goes. Now, on the concerning side of the Trump policies, you've got tariffs. Okay, listen. It's not an even playing field, folks. Understand that, okay? We're getting tariffed to death by other countries. It's not an even playing field at all. And I get frustrated with economists who talk about tariffs being anti-free trade, anti-capitalist, when they don't talk about how we're being tariffed, okay? And we are. So I think there's a role for tariffs to even out the playing field and try to make things a little bit more fair for American businesses. But they're going to have an impact. They did last time. There are a couple of times where the tariff policies that came out of the administration just didn't seem to be well thought out. They caused some unintended consequences. There were exceptions that had to be made and things like that. Now, all of that said, the Biden administration never took a single tariff off the table. They left everything in place that was put in during the Trump administration. But the way the policies rolled out, they really seemed to be a little bit haphazard at times. And the market was volatile because of it. Then we've got overall uncertainty just because of Twitter or X, whatever you're calling it now. Look, things can be said over any given weekend that can cause a lot of turmoil on any given Monday in the stock market. I get it. That's how you sometimes negotiate your way through things. You have to kind of keep people on their toes, but it doesn't mean the market's going to like it a whole lot. So I'm just kind of making you aware of that. And then finally, the other thing that concerns me right now about the Trump administration is the debt limit. Just this past week, they tried to pass this spending bill eliminating the debt ceiling. Now, I understand the arguments for doing such a thing. We don't want to be looked at around the world as a country that may not pay its bills and yada, yada, so on and so forth. I get all that. But look, folks, we've got two parties that are running this country, have been running this country for decades. And we went from budget surpluses in the late 90s to $2 trillion deficits today. $2 trillion deficit per year. We went from debt to GDP, and I have to go back and look at the numbers, but it was probably somewhere around 20%, 30% in the late 90s to now 130% debt to GDP. It is off the chart. We've not been here since World War II, and our spending is completely different than it was when we were here last time. I'm not going to go into details. We've talked about it before, but we're in a mess right now financially. To just remove the debt ceiling, I think is reckless. I don't think you want to give carte blanche to any party to go ahead and do what they want when it comes to racking up debt on the U.S. economy, because they have proved themselves unworthy of such a privilege. And I think we need to keep that debt ceiling in place. So at least we can have a conversation. Even if it's sometimes, seems like it's all for political gain and there's really no bite in the bark and they push things to the limit, whatever, at least the conversation's happening, and I think it needs to happen. So those are a lot of things going on. I already mentioned I'm pretty excited about the Department of Government Efficiency. But listen, folks, that can have a negative too. I mean, although I think in the long term, we have got to clean up how our government is functioning and how it is blowing our money. Because remember, the government doesn't produce anything. They produce nothing. They generate no revenue. The revenue comes from you and it comes from me. They take it, okay, to provide services in return. That's where the revenue comes from. They generate nothing. All that said, if we start going in and doing a lot of cutting and let's say a lot of folks get furloughed and lose their jobs and things like that, maybe the government becomes more efficient and that's good for us long term, but that's going to add to higher unemployment and lower GDP. Keep this in mind too, the government's about 30% of our GDP, 30%. And if that takes a hit, that hurts growth, that hurts the economy, that could be recessionary. So what could be good for the long term could be painful and volatile in the short run. And these are things to be mindful of. Now, what do you do about that stuff? Nothing, because you don't know what the policies are going to be. You don't know what's going to come out. You really just can't do a whole heck of a lot when it comes to trying to manage for geopolitics. And anybody that does that gets burned. Time and time and time again, you get burned. You listen to these talking heads on talk radio and you get all worked up and the sky is falling, the end of the world is near. And you know what? You'll lose your butt because you listen to Chicken Littles instead of paying attention to the numbers. So you don't do a whole lot when it comes to geopolitics. But these are things just to be aware of as far as volatility is concerned. All right, so what do we want to pay attention to when it comes to the markets and how we're investing? Well, that's it, the market. So let's talk about that. We are coming into 2025 with a stock market, folks, that is stupid expensive. I mean, it is nosebleed expensive right here. The S&P 500 and individual stocks, they're measured by what we call the PE ratio. That's the price to earnings ratio, okay? So if you take the S&P 500, which as of close today, it closed at 5,970. That is all the stocks of the S&P 500 all put together, 5,970. Now, if you took all of the earnings from each one of those 500 companies for 2024, how much did they earn? $237 per each $5,970 share. So for each $6,000 share, $237 was earned. What does that mean? It means that the S&P 500 is trading at 25 times earnings. That means if you buy it today and all these companies continue making money at the same rate they're making it today, their earnings don't grow, they just stay the same. It will be 25 years before you'll get your money back in terms of earnings on the price that you're paying for the S&P 500 today. Now, I hope I'm not losing you too much on that, but just look at it this way. The S&P's closed today. Let's round up and say 6,000. Take $237 a share of earnings, divide that into 6,000, 25 times earnings. That $6,000 only made $237 this year. Now, what does the street expect for next year? The street, when I say the street, I'm talking about all the other firms out there, all the other wealth management firms, money managers, talking heads, etc., pontificators of the market. They're expecting an average of around $272 in earnings for 2025. That's a 14% increase. Now, first of all, 14% increase is a great year, a monster year in earnings growth. That's the kind of year you see coming off of a slow economy, not off of an economy that's been a bit overheated. I think that is a pretty aggressive expectation to see 14% earnings growth. And then you take a look. Let's say they get that. Let's say they get $272, okay? If the stock market didn't change, if it stayed at 6,000 and this time next year was still at 6,000, it'd be at 22 times earnings at $272 of earnings growth. Still expensive. You know what? Let me help you out with this. Let me give you something to compare it to. Since 1871, the average PE ratio on the market is 15. The last 10 years average, 18. The last 5-year average, 19.7. Where are we today? 25. Where will we be next year if we get $272 of earnings and the market doesn't move? 22. 22. Look, the street's thinking the market's going to be at 6,600 to 7,000. That puts us at 24 to 26 times next year's earnings if they get the 14% growth. My point with all this is very optimistic. I just think very optimistic. I think too optimistic. And I think we have to be a little bit more measured and lower our expectations in regards to growth and certainly in regards to PE expansion. Now, the market can continue to get more expensive, folks. It has in the past. I mean, some of these bull markets end with the PE ratios over 30. But right now, I'm looking at not only the PE ratio, I'm looking at the Warren Buffett indicator. It's at a historic highs right now, off the chart, never been this high before. The Case-Shiller index, also off the chart, very expensive. Point being, there's no metric out there anywhere that says this market is of good value right now. So that's what we're starting off the year with, a market that is expensive. And even if we get the 14% growth and the market doesn't move, it would still be expensive. So what are we looking at to try to combat that? Well, there are some cheaper areas in the market. Energy right now is trading at a multiple of a fourth of what the stock market is. Financials, much cheaper than the overall market. There's areas of healthcare that look pretty good. Small cap stocks still trading at a historic discount to the S&P 500. When it's been this much of a discount in the past, small caps have come through really strong and outperformed. In times in the past, for as long as 10 years, they've outperformed and by a significant amount. Foreign equities look much cheaper than the S&P 500. The problem with that is the world's on fire right now. I mean, everything's a mess, right? I mean, gosh, all these foreign governments can't get their act together. They're all struggling. They all have got issues. And Japan's got their yen currency issue, and Germany and France are a wreck. And South Korea, well, it's got 2 presidents impeached in 2 weeks. It's just a mess out there. China can't get off the mat from COVID. They're still down and out. So there's some concerns there, but there is value overseas. And we're exploring that very cautiously and in depth to try to see where we can maybe allocate some money to take advantage of some of those dislocations between foreign and U.S. The other thing we're trying to do, lean a little bit more into dividends, right? If you got stocks that are paying great dividends, you don't need the market to go up so much to make your money. You bought Pfizer there a couple months ago. It's paying a 6% dividend. Pfizer's paying a 6% dividend. It's trading where it was 10 years ago. It's PE, forward PE for next year, a 9.1. If the stock doesn't move, I kind of don't care as long as they continue to pay in that dividend, right? I'll take the 6%. And then when it does move 2, 3, 4 years from now, whatever, great. If it moves sooner, hey, that's good too. Now, these energy stocks, they're paying 4 or 5% dividends. Financials, they're paying 3, 4% dividends. There's areas out there where we can lean into the dividends and depend on that to help us with a return. The second thing we're going to look at is bonds. And we do have more money in bonds we've had in quite some time. Look, the last, 17, 18 years, bonds have been lousy, awful, paying 1%, 2%. If you're a long-term client at BIG, I mean, you know how I despised bonds for so long. You know that we were underweight for many years. And even what we did have in bonds as protection was a bit of a dead weight in the portfolio, right? It kind of hurt returns. We're trying to be prudent, but at the same time, it was a headwind against returns when you had money in bonds. Well, you same folks have been in shock when you've had your recent appointments and you've noticed that we're at 30+% in bonds. Like, whoa, what happened there? Well, we're getting 5 to 8% now. That's what happened there. Bond rates are much, much higher. They look much more attractive as far as a risk return opportunity versus the stock market. But listen, there's still concerns there too. I mentioned on the open, there is something fishy going on in the bond market, something that is very concerning to me. Never in history has the Fed cut rates and long-term bonds risen as much as they have during this rate cutting cycle. Never has it ever happened before. What in the world is the bond market trying to tell us? What in the world is the bond market concerned about? Now, what's interesting about this is that if the market was afraid of recession, if the market was afraid of a weaker economy, normally people are buying bonds and rates are going lower, okay? So when people are afraid, they're trying to find safety, they buy bonds, rates go down. Well, the last month and a half, 2 months, rates have gone straight up. The TLT, as we talked about, it's been just getting crushed. People are selling long-term bonds and rates are going higher. Why is that? Well, it's one of two things, folks. Either the market is having a sincere disagreement with Jay Powell and the Federal Reserve, and the market thinks that inflation's coming back. And maybe that is what it's thinking. Under a Trump presidency, there's a couple of things that could lead to that. If the economy picks up speed because lower energy prices and less regulation, and then prices go higher because of tariffs, you could have like a double whammy effect on inflation. Maybe it's worried about that. What I hope it's not worried about is the U.S. debt situation. If the market's starting to become fearful of that, we could have much bigger problems on our hands. I tend to think that's not the case because everybody else around the world's a mess. Okay, Japan's got twice the debt to GDP than we do. China's got a ton more than we've got. Europe is a financial wreck. And when the world is afraid, they're still running to U.S. bonds and U.S. dollars. So I don't think that's the concern right now. I think maybe it's looking at inflation and it's disagreeing with the Federal Reserve, but it's something that I'm keeping really close eyes on because if it's the latter, it's a bigger problem. It's a different type of issue to contend with. If it's the inflation issue, well, we can work with bonds and still work our way through that. Look, right now, what we're doing, all the bonds that we have are short term. We're sticking with really short-term bonds because they are less impacted by rate movements by the Fed. The Fed raises or lowers rates. It doesn't impact the bond portfolio anywhere near as much as long-term bonds do. Look at it this way. If you've got a bond that's 20 years long, paying 3%, and brand new rates come out paying 5%, nobody wants your bond, right? And now you're stuck with it for how long? For 20 years before you get your money back. And of course, the other way, bonds will go up. If you got 5% and new rates are only paying 3%, then your bond goes way up in value because, man, 2% for 20 years is a lot of money. The 3 to 5 year, 3 to 7 year bonds, they don't move anywhere near as much as those 20 and 30 year bonds. And that's what we're sticking with right now, short term, because I don't trust it. I don't trust what I'm seeing. The long-term bond market is saying something, and I'm listening. So we're staying away from them right now, and we're sticking with the short-term bonds. We also have some high-yield bonds. We've talked about the Manning and Napier high-yield bond fund. Great investments, paying 8.5%. I've talked to the management, Mark Bashalo. He's ran it for the last 15 years. So the performance is all his. And I feel real comfortable with his game plan on how to manage those funds if the economy were to start to fizzle out or deteriorate. We got a good deal there. I mean, right now it's closed to new investors, but we have an exception that we can get still people into that particular fund and it's paying a great rate of return. So those are some things I'm looking at. Adding a little bit more money to bonds, maybe even looking at some foreign bonds too to help diversify a little bit further. These are all the things that just kind of like in my focus right now as far as where to go and how to diversify things out to get a decent return in a year that I think is going to be volatile and a bit more modest in regards to returns. So what else? The dollar. The dollar continues to strengthen. I mean, on one hand, that's good for us in inflation, but my goodness, it really does hurt corporate earnings, especially for the multinationals. Now, as I mentioned earlier, small caps are trading at a big discount to the S&P 500. Small cap stocks in America are not going to be as impacted by the strong dollar as they're not doing a lot of international business. They're also not going to be as impacted by tariffs because they're not importing things to sell to U.S. consumers. And they're probably going to they'll have a larger benefit from easier energy and lower regulations. So I think small caps can maybe benefit from some of those things moving forward while some of the other areas struggle with it. So putting it all together, what are we going to do about it, right? It doesn't sound too good, right? I understand. There's nothing to be worried about though. Listen, one thing we never do is bet the farm on anything. We want to keep it spread out. So what we're doing at this point, we are going to slow it down. We're pulling more money out of the U.S. market. We're adding more money to fixed income type of investments, focus more on dividends when it does come to our equities, and also looking at some more international exposure to round things out. So adding diversity, adding to undervalued areas. We've got good energy exposure. We've got great small cap exposure. I love where we're sitting in those areas. We may not get the big double-digit outperformance from those areas anytime soon, but I would have to think there may be a little less downside potential because they're already underperforming versus the S&P 500. So slowing it down, taking away some money from some of these big winners, adding it to some undervalued areas of the market, adding more to fixed income, looking to add a little bit more overseas. I haven't fully nailed down the overseas exposure yet. I'm still doing some deep work on that and just haven't made up my mind exactly what direction we're going there, but getting pretty close. So that's what we're going to do, folks. And listen, I just say go into 2025 with tempered expectations. I still think we'll have a good year. I think we'll probably see positive single-digit returns, probably upper single digits. And look, we may do better with small caps and energy. If some of these things start to catch a bid and a little bit more investor attention, hey, we could have a pretty nice year where the traditional S&P struggles a bit because those top 7 stocks that have been keeping the whole thing elevated start to underperform. And I think that's a high possibility. So that's what we're doing. I like the game plan that we've got in place. Nothing to be fearful about. I know I sounded a bit negative, but what you don't do is sell everything and hide under a rock. You know why? Because it could end up being one of the few times in U.S. history where we have 3 monster back-to-back years in the S&P 500 with another 20-plus gain return. It can happen. It can absolutely happen. Expensive markets can get much more expensive. These high valuations can last 3-4 years sometimes close to 5 years before they really start to roll over. We don't want to use the expensiveness of the stock market as a timing tool. It's a mistake to do that. What we do want to do, and what I think we can do, is be more diversified, slow it down, and still have enough exposure in the broad market that if it has a big double-digit year, we'll make money. And if it doesn't, we'll make money. That is the game plan, to try to be covered no matter which way things go. The other thing I'll say is this. As some of you have been with me for a long time, there are certain indicators that are lines in the sand to me. One in particular. There's one particular indicator, and I'm not going to divulge it on the podcast because my competition listens. But when the market breaks this indicator, we're selling the crap out of the market. We're raising up a bunch of cash, plain and simple. And given the backdrop that I see right now, I'm not going to monkey around with that. If it breaks the indicator, I'm raising up a ton of cash. I'm doing it very quickly. We're far from that right now, not even close. But in addition to doing the diversifying, slowing things down, I'm also going to be more vigilant, very vigilant mindset when it comes to reacting to indicators that I think spell trouble. So that's the game plan for 2025, folks. I think it's going to be fine. I like what we're doing to prepare for it. So between now and next week, listen, I know it's a long one. I'm so sorry, but it's a lot to cover. So 2025 outlook, there's a lot to talk about, and hopefully you got some good information from it. But between now and next week, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money, maybe it's buy a Bitcoin, which I will tell you that is ridiculous and you should stay away from it. That thing lines right up with the NASDAQ. It's crazy town. Maybe it's take a big trip, buy a second house, retire a little early. You know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.